infrastructure, on quantum. This arms race happened between U.S. and China. You need to see from the White House, they're going to continue to make stakes. No different than Intel, where they've done raw materials. Quantum was going to be the next step. And I just think where IBM is positioned so well on this front.
But to follow up on what Kelly's saying, and we won't get into the energy. If quantum works, the energy demand story changes dramatically. We'll save that for a different day. Where are we in quantum? Is it still a fantasy? Are computers running? What's the Dan Ives view on where we stand? You always like to say what inning we're in.
Sure. So if it's inning, we're maybe in the dugout in warm-ups, getting ready for the first inning, right? Okay. In other words, like because right now
game hasn't started.
Game hasn't started. If you look at a lot of the projects that's going on in quantum, they haven't really hit scale. If you look at IONQ, D-Wave, Rigetti, what they're doing, phenomenal technologies. Now, slowly, they're going to continue to build that out. But
if it works, though, are you convinced this is all going to work?
Look, I believe that, could there be bumps in the road? Yeah, but I believe over the coming years, this is a core technology that, in our opinion, it also plays into the fourth industrial revolution. Because it's not just about Godfather of AI, Jensen. It's about, you have to continue to think about on infrastructure, on software, on quantum, on power. And I think that it's our view. That's how we're going to get in NASDAQ 30,000. It's just going to be these other derivative plays.
IonQ up 11%. Some of these names are up 20, 30% today. Not to go on a complete tangent, but Brent, should energy investors be excited by or nervous about energy?
Nervous.
So
because quantum will use, the idea is that, and Dan, correct me if I'm wrong, it will consume less power to do greater computational effects. So the compute, all the horsepower, the energy used to power all the data centers will narrow out because these...
Like wealth management joining us here at the big board. So we're seeing a risk-on kind of day, and this comes in the aftermath of what we hear over the weekend on the U.S. Between the U.S. and Iran reaching essentially what seems like finally a peace deal. We don't have the terms of the deal in front of us yet, but does this reaction on Wall Street make sense to you, Ted?
It does, Diane. I mean, honestly, obviously, so much has happened with the price of oil. We see oil futures down. Equity markets are going to like that. There's been a lot of course, consumer pressure with this war. And to see a light at the end of that tunnel is really important, especially as we head into the Fed chair week. Kevin Warsh sitting down at the helm for the first time. I think that this kind of news makes his life a lot easier this week.
It makes it easier, but it's not going to be an immediate off-ramp. Yes, we're seeing oil prices come down right now as we sit around $80 a barrel for WTI. Brent crude also coming down. But it's not like a quick a flip of the switch, essentially, to move the flow of oil.
No. It's, we've had a supply shock in the oil system. And, one analogy I've heard a couple times is it's kind of like a bowling ball that has to move its way through the boa constrictor of the economy. We've been at this now for 4 months. I think, even if under the best of terms, if we continue to see oil go down, it's still going to take at least another 2 months. I think the administration hopes probably we get to more stabilized oil prices, inflation metrics by the midterm time frame. So you're absolutely right. It's not a flip of a switch, but it is, positive, I think, moving in the right direction. And that's why we see, the market's green today this morning.
And inflation has been stubborn, and we've seen an uptick, whether we're talking about CPI recently, PPI, numbers that you don't love to see. Obviously, a good portion of it has been energy and PPI. They've kept that contained away from the consumer so far. But do you think there is some risk of us still seeing some hot inflation for a little while longer?
Certainly. I hope that the most of the inflation is behind us in terms of the push up, because we had that a couple weeks where we were at not just $100 a barrel but 115, 120 at times. We came back down from there. We've sat in the 90s here, so I do believe the worst is behind us. But it wouldn't surprise me at all if it takes, again, quite a little bit of time here for that to work its way through the system. My concern really would be is if we started to see it filter through all of the core metrics. So far, it's been contained to the headline number, especially on the CPI and PCE. But of course, if it filtered down, that's where I would say, consumers would be in more trouble.
What's the biggest worry of your clients?
Of course, consumers have been under pressure. Costs and inflation tend to be retirees' number one concerns. Obviously, investors want growth and good upside, but especially, the folks we work with being in that more retirement phase, they also want to make sure that, hey, their downside's protected, and they know they're going to be able to pay their bills month to month and keep things stable. And so definitely the pressure of inflation and costs is a huge concern.
What's the hedge that they are asking about?
When it comes to, risk mitigation, there's a lot of different strategies, investors will use. I think fundamentally owning quality companies at quality valuations really gives investors a lot of, safety through diversification. And so fundamentally, those are the types of things we look at when we think about a hedge, especially for the retail investor.
And then when you think about risk assets, obviously we're seeing tech off to the races once again, with the off-ramp seeming to come sooner rather than later for the U.S. and Iran. Is the tech sector still in a position that you like, and does this make sense to you?
I think there is a discussion these days about whether or not we kind of come out of this rally again with too high of valuations. When it comes to the big tech names and the mega cap names, really, I think it's about where we look. The truth is a name like Nvidia, look at its forward earnings right now. It's trading at about 20 times forward earnings. That is near its 10-year low forward trading multiple. The low of the last 10 years is about 18.5 or so. So a name like that actually is really attractive to us. Same with Microsoft, trading at 21 times forward earnings. Near its
Why memory stocks suddenly crashed before Micron earnings? Before Micron reported earnings, AI-related semiconductor stocks experienced a sharp sell-off. At first glance, many investors assumed something has fundamentally changed, but that wasn't the real case. The actual selling began overnight in South Korea. The Kospi index fell nearly 10%, triggering heavy selling across the memory stocks, especially SK Hynix and Samsung, two of the world's largest memory manufacturers. Several factors came together. Reports suggested that SK Hynix was temporarily prioritizing the production of higher margins general purpose DRAM instead of accelerating some HBM4 production line. Some investors immediately interpreted that weaker demand for NVIDIA next generation Rubin platform, but that's not what report actually implied. If anything, it suggested that memory remains so supply constrained that manufacturers are allocating production toward the whichever product generate the higher returns. That's supply issue, not demand issue. At the same time, South Korea's stock market has become heavily leveraged. Margin dips have reached the record levels, and regulators warned that the semiconductor-related ETF has become overheated. When investors began to take the profits, leverage selling accelerated the decline across the entire market. The result was panic selling in memory stocks worldwide. Did AI demand suddenly slow? That's the question everyone started asking. The answer, based on virtually every industry data point available today, appeared to be answer is no. Multiple analysts covering Taiwan and Korea said their supply chain checks still show the AI demand accelerating. Several investors described the current environment as roughly 15 units of demand for every 1 unit of available supply. Even companies that are building billions of dollars of new manufacturing capacity still cannot keep up with their customer demand. That's why prices remain elevated. That's why margins continue expanding, and that's why companies like Micron are signing multi-year customer agreement. The debate isn't whether the demand exists. Everyone agrees that demand is enormous. The real question is how long can this last? Historically, memory has always been one of the most cycling industry in the technology. When prices become attractive, manufacturers expand production, and supply eventually cause the demand. Prices collapsed and margin disappeared. Investors who bought near the top often suffered. That's why memory companies traditionally traded at a very low valuation multiple. Today, however, many investors believe this cycle is fundamentally different. Instead of consumers, electronics driving the demand. Artificial intelligence has become the dominant customer. Every new AI models require more memory, and every new GPU generation requires more HBM. Inferences workload continue expanding. Agentic AI requires larger memory pools, and physical AI and humanoid robots could increase memory demand even further. If that is true, then today demand memory cycle could will last longer than previous cycle. Why Micron earning becomes so important? Going into the earnings, Micron wasn't just reporting quarterly results. The company was effectively answering one of the biggest questions in the technology. Is this another normal memory cycle, or AI has fundamentally changed the industry economics? Investors wanted the answer to several critical questions. Are gross margins sustainable above the 80%? Will pricing remain strong into the 2027 and the beyond? Are customers still placing massive long-term orders, and is AI demand beginning to slow? As it turned out, Micron answered every one of those questions positively. Management confirmed strong pricing and tight supply beyond the 2027. They announced the 16 strategic customer agreement. They revealed approximately $100 billion in the committed backlog. Those are numbers typically associated with the traditional commodity business.